As we head into business in 2026, we track how the global energy map is being redrawn. A dramatic recent leadership change in Venezuela, marked by the ousting and capture of President Nicolas Maduro and contested claims over who now controls the country's vast oil resources, has injected fresh uncertainty into oil market and could reshape supply prospects. While analysts say a shift away from long-standing sanctions and political isolation may eventually open Venezuela's huge reserves to broader export flows, though risks and geopolitical tensions remain high. While years of sanctions, underinvestment and infrastructure decay limit any immediate surge in output, the developments put renewed focus on the country that holds the world's largest proven oil reserves. Estimates suggest that Venezuela has roughly 300 billion barrels. That exceeds even Saudi Arabia's proven reserves. The shift is ongoing. The US is now a net exporter of oil and has used the dollar-based financial system as a central tool for sanctions. In response, some oil-producing nations are experimenting with alternative settlement currencies. The so-called petro-yuan is no longer just theoretical. It is being used in select bilateral transactions and threatens the dominance of the US dollar in the global energy trade. Major exporters, including Saudi Arabia and the UAE, have signaled openness to non-dollar settlements in limited cases, a move that could gradually reduce the dollar's role in energy markets. However, experts note that this is not the end of the dollar, as some reports claim. The clearest example of the shift lies in the expanding trade relationship between Moscow and Beijing. Russia is one of China's top oil suppliers. Russia exports around 2 million barrels of oil per day, with China accounting for nearly half of Russia's crude exports. An increasing share of this trade is settled in yuan and rubles. In 2025, Russia's energy revenues declined significantly due to sanctions and lower prices, yet export volumes have remained resilient. China, meanwhile, exports technology and vehicles to Russia while importing discounted energy. But as demand for crude oil slides, the real contest isn't just over barrels. In 2026, it's over which currency ultimately pays for them.